Welcome to Getting a Mortgage 101. This presentation is geared toward all the stuff that gets missed in the typical home buyer seminars. This video will focus on what factors into your pre-approval, your cash flow strategies, and the cost you can expect when buying a home. Over the course of my career, I've always felt it was important to not only get someone the best mortgage, but to also make sure they understood why I was making certain recommendations. This is one of the biggest decisions you will ever make, and you will need to be well informed about the best way to achieve your goals. My name is Brian Hunton. I've been a licensed loan officer for almost 15 years. During that time, I've built my business on realistic, reliable pre-approvals and extensive communication both with clients and referral partners from the start to finish of the mortgage process. I have an extensive history of community involvement, including terms as a president of the Chamber of Commerce and local Rotary Club, among many other charitable boards. I was also recognized as a top fundraiser for the Massachusetts Disabled American Veterans. If you'd like to see what some of my past clients have said about me, please feel free to visit my lender page on Zillow. Let's get started with why I created this presentation for you. I have spent years and years in the industry, and people always start with a conflicting message. They want to buy a home in order to stop paying someone else's rent and have something for themselves. But in the next breath, they talk like their end goal is to get that house paid as quickly as possible at the expense of the rest of their financial goals. Now, this isn't going to be some advice that says your goal doesn't have to include paying off your mortgage. The advice is going to be to remember that the reason you want to buy a house is that you want to improve your financial situation. Your home is more than likely going to be your largest asset the day you buy it, and your mortgage is more than likely going to be your largest liability. That's why we have to remember that your home mortgage, and how you manage them should be set up to help complement the rest of your financial goals rather than go against them. The things we will go over will cover the basics you need to know, but we'll also have this concept in mind along the way. There are four main factors in the mortgage pre-approval process. The first is credit. Credit scores normally range from a 350 to an 850, the higher the better. The type of score you have will immediately impact that type of mortgage we can work on for you. In addition to the score, we will be looking at the history of late payments, especially over the last 12 months. Bankruptcies and negative public records will also impact you. The second factor is your employment history. Ideally, we will review the last 2 years of employment. The more consistent that history is, the better. If there are a number of gaps in employment, or if there has been excessive movement from one place to another, that may impact the lender's decision on whether to provide financing for you. If you are young and don't have a 2-year history yet, schooling related to your current employment will bolster your employment history. The third part is your income. This is pretty simple. The more you make over your current monthly bills, the more you can afford for a potential mortgage. We would also be reviewing a 2-year history here. If you make a standard dollar per hour with set hours, that income is used for qualifying. If you have overtime, commissions, and bonuses, that income will be averaged over 2 years, and will also have to show that you are on pace for the same for the current year we're in. Lastly, your assets are reviewed. This could be for how much you have for a potential down payment, or if you have enough funds to close. If you're looking at a no money down option, this could be considered as reserves. For example, if your mortgage payment is projected at $1,500 a month and you have $3,000 in the bank, you may get more flexibility on a lender's approval than someone with zero, because you have 2 months of reserves to fall back on. Once all of your personal information is reviewed, the next step is figuring out what mortgage products you qualify for and what products would work best for you in your particular financial situation. Your credit score and down payment availability are the 2 biggest determinants, since they are dictated by established underwriting guidelines. Mortgage insurance will vary depending on product and or credit score, so this may make us lean towards one product over another to keep your monthly payment down. Your income and debt ratios will then finalize where you fall. Ratios are broken down as a top or bottom ratio, also called a front or back ratio. The top ratio is the percentage of your gross monthly income that can be used toward your housing payment. This includes principal, interest, mortgage insurance, home insurance, and taxes. The bottom ratio is a percentage of gross monthly income that can be used towards your projected housing payment, as well as your minimum reported payments from your credit report. Each general loan will have a different established limit, so depending on where your income falls, where your debt falls, and where your desired price point is, will determine the last piece of the puzzle for you. There are a myriad of loan product and loan options, far too many to list, and some are for very unique circumstances. With that being said, most potential homeowners are going to fall into these 3 main categories. Conventional are what we would call Fannie Mae conforming loans. These loans will generally have a 3 to 5% down payment, but there are options as low as 1%. These loans are subject to private mortgage insurance requirements. That insurance will be based on risk, so the lower your down payment and the lower your credit score, the higher the insurance will be. While they will take scores at a 680 and sometimes below, That is at the bottom end of their spectrum, so the PMI can be fairly expensive until you're into the 700s on credit. These mortgages will typically cap out at 45% top and 50% bottom debt ratios. You could do 1 through 4 unit properties with a conventional mortgage, but the down payment increases when it is more than a single family residence. Also, this is where your investment property and second home mortgages would fall. Both would require higher down payments. The second group would be mortgages where the mortgage insurance company is the Federal Housing Administration. These are called FHA loans for short. These loans are much more tolerant with credit scoring than a conventional mortgage. FHA is pretty straightforward with a score upwards of 640, but they can go lower down to the high to mid 500 scores. However, when the score is lower, there becomes a new list of requirements with increased down payments, lower debt ratios, more assets required, etc. FHA typically has a 3.5% down payment, but we also have multiple lenders that will do a down payment assistance program where they will lend you the 3.5% down payment as a second loan. Those options come with additional restrictions, so we won't be going into much detail on that in this slide. FHA will charge an upfront mortgage insurance premium that is set at 1.75% of your loan amount. This is added to your loan and spread out over 30 years. They have a monthly mortgage insurance that is a standard 0.85% of your loan. This differs from conventional loans where your PMI is based on credit. No matter what your credit score is, the mortgage insurance for FHA will be based on the loan amount. You can buy a multi-unit property up to 4 units without an additional down payment. FHA offers a higher debt ratio tolerance going up to 45 on top and 55 bottom, so this may also be a great option to help get into a little bit higher price point when necessary. The last of the major options is another government loan that is guaranteed through the USDA. This is the easiest path to a no money down loan that maintains a lower 30-year fixed rate than the other two no money down options. This loan, like the FHA, has an upfront mortgage insurance premium and a monthly mortgage insurance. However, they are much lower at 1% and 0.35% respectively. In many cases, if we compare a USDA loan to an FHA loan, they will have the same overall payment, but without any money down, so USDA is normally a first choice when possible. They still have a fairly low credit requirement of a 640, but they are looking for a generally cleaner credit report. USDA is also fairly strict with debt ratios with a top of 29 and a bottom of 41. If the buyer has excellent credit and a good length at their current employment, you can anticipate getting closer to a 32 or 44. They will not allow a property that has any income-producing potential, so if there's a rental unit, a commercially equipped barn or garage, etc., the property would be ineligible. There are also income and geographic restrictions. We will cover that specifically with each client, so if you have a question regarding your income and location eligibility, feel free to ask. Lastly, I don't have it here on the slide, but the VA also offers some great loan options to veterans, but since it is for a unique group of clientele, I didn't include it here. If you are watching this and you are a veteran, please feel free to reach out and I will go over those options with you. Now that we know the main types of loans we could consider, the next piece of the puzzle is figuring out which option and which down payment is the best for you. You may be in a situation where there isn't a choice and we have to go with a higher debt ratio, so we go FHA, or we don't have any money to allocate to down payment, so we go with USDA. But if you're in a position where you have money and we have to determine how much to put into the house and how much not to, this section is some food for thought. What is right for one person may not be right for the next, so we have to make sure that we are matching up the strategy with your particular short and long-term financial goals. In terms of a down payment, what makes a good investment? Typically, when someone has a lot of money that they want to allocate to the mortgage, they want to focus on making sure they don't have mortgage insurance, keeping their monthly payment lower, and paying off the mortgage quicker. But does increasing equity in the house with a bigger down payment make a good investment? 3 general keys to consider in terms of investments are the liquidity, which is how easily that asset can be utilized if necessary. The second is rate of return, or how much that investment is going to earn for you. The third is how safe is your principal. Strictly talking about equity in your house, does it pass this test? The equity isn't liquid at all, and it would cost you money for closing if you were to refinance to access it. Plus, you would have to qualify for the new mortgage. How about rate of return? The return is 0. You may be saving on interest paid over time, but that doesn't equal earning money. Also, since this mortgage interest is paid is currently tax deductible, we are comparing apples to apples anyway. That leaves safety of your principal. Is your down payment safe? That all depends on the market. If you put down 10% in 2006 and the market declined by 10%, what happened to your investment? It may be a paper loss, but that doesn't matter unless you're in a position where you have to sell. But the money you invest in your home is always subject to where the real estate market is headed. How does this factor into the rest of your financial picture? What are you planning to do with the equity in the house when you get it? If you have the rest of your financial picture in place and won't ever need the money, maybe it makes sense to put it into the house. But if you know you will need to borrow it again to pay for college or to have funds during retirement, why are we putting so much into the house in the first place? If you think the ability to retire falls solely on not having a mortgage payment with little concern to creating more assets, there is probably a better way to get to the asset point you need to continue on to live your life in retirement. Another thing to consider is how much are you going to save to give up that liquidity and rate of return. If an extra $10K gets you savings of $60 a month, you have a break even of almost 14 years to recuperate your own money. Would it make more sense to keep that money liquid and use it to pay the difference? That way, if you ran into a situation where you couldn't swing the extra 60, you would have it there already. The following is a little case study to help illustrate the point. I want to reiterate that not every client is going to get the same advice from me, and I will end up writing whatever loan and whatever down payment you decide on. My job is just to get you thinking about the bigger picture to help you reach your financial goals. But you are ultimately the person that will be deciding what mortgage is best for you. The case study will illustrate the two mentalities that people have when they approach their mortgage. The first will go over the person that wants to pay down their mortgage as quickly as possible. The second will cover the client that is more interested in an overall better balance sheet. So in the first example, we have someone whose goal is to pay off the mortgage as quickly as possible. Their long-term strategy for financial freedom is to put themselves in a position where they pay off their mortgage as quickly as possible to avoid as much interest as possible and be able to eliminate that portion of their monthly debts. In this example, they make one additional payment each year to work towards that goal. And by doing so, they are able to take 4 years off their repayment. And at the 26th year mark, their asset would be worth $554,000 based on a 4% appreciation average of the house value. In the second example, the client's goal is to create liquid assets and an overall positive balance sheet. They take the additional payment that client A took to pay off their mortgage and they invest it for an average of a 6% rate of return. At year 26, they have assets greater than the remaining balance on their mortgage and have earned slightly more than client A for overall assets with $15,000 additional. Based on the growth they've had in the side money and the value in the house. Some points to remember on these illustrations that they are extremely basic with minimal factors being considered. We haven't taken into account varying down payment strategies, tax avoidance, the money client A could start earning at year 26, etc. The point that I'm trying to drive home with these examples is that you can get to the point where you are debt-free, whether that means paying off all your debts or whether that means having assets that are greater than your debts. Paying off the mortgage as quickly as possible may not be the best approach because if you lose your liquidity and the ability to utilize those assets for emergencies, such as home repairs or a loss of job, the focus should be on overall net worth and preparing for the unexpected. What strategy should you employ? Each person's situation is unique. It is important to look at your current financial goals in purchasing a home for your initial strategy and to continue to look at that where you stand periodically over the course of the mortgage to make sure your goals are still the same and to make sure the strategy you are using complements those goals. The beginning of this video covers a lot of information about what direction you should go in with your mortgage strategy. This last section covers some more basic information that applies to everyone getting a mortgage. We'll start with the two questions that get asked the most frequently. What is my interest rate and what will this cost me? We'll get started with the more complicated part first and address what determines interest rates. This slide shows the flow of where your mortgage money originates from. On the right side of the screen, you'll see Wall Street. This is because the main driver behind mortgage rates is the supply and demand of mortgage-backed securities. A mortgage-backed security is a type of bond that provides lower risk in a volatile market. Since they have less risk than stocks, they are in much greater demand during unstable economic times. When that risk decreases, those investment dollars return to stock purchases. This ebb and flow of money will increase or decrease home mortgage rates. As a general rule of thumb, when bond prices rise, home loan rates decline, and when stock prices rise, home loan rates increase. A number of monthly and quarterly economic reports will have an impact on this market. Most notably are inflation, unemployment, the gross domestic product report. Additionally, retail sales report, the Fed meeting reports, manufacturing reports, and geopolitical events ranging from natural disasters to trade wars between countries will also have a major impact on rates. Now that we have all the information on how rates are determined, how do you go about getting the best rate? The biggest part of that is forecasting movement by using the fiscal literacy I just explained There is no way to predict exactly where they will land, but you can determine repetition of the up and down movements by monitoring all these economic reports. The second part of working on getting the best rate is shown more within this chart. From right to left, you see Wall Street and mortgage-backed securities as the origination of mortgage money. Next are the large investors of mortgages that create the securities to be bought. This is where Fannie Mae and Freddie Mac come into play, among others. Those investors then make money available to lenders. This could be your local bank, or an example of a mortgage broker such as myself. This would be a wholesale lender with a much larger scope than your other local retail counterparts. Then you have the loan officer that helps secure the money from that lender for you. In most circumstances, these wholesale operations have a much larger buying power and therefore will get a better price from the investors that loan officers can take advantage of for you. There are a lot of moving parts here. Unfortunately, there is no test you need to pass about mortgage-backed securities to get a mortgage. But when you're going through the process with me, just rest assured that we have our proverbial finger on the pulse of the market to help you secure the best rate available for you in the time frame ahead of your closing. Now we can move on to a little bit of lighter information. So take a deep breath, refocus. We're almost at the end. There are a few out-of-pocket costs that you can expect when getting a mortgage. The first expense will be your initial deposit with your offer. This will typically be somewhere between $100 and $500. If the seller accepts your offer, they will put your money into escrow as consideration to bind your agreement. Once you have an accepted offer, you will have an inspection period, which is typically 10 days. You can bring any inspector you want to the house, but generally you have one home inspector who specializes in homes and has knowledge of all systems within the house. The home inspection is not required for the mortgage, but is extremely highly recommended to make sure you are aware of any issues with the home. The typical cost is between $475 and $575, but will depend on who you select. When you are satisfied with the home inspection, you then get to your purchase and sale contract. When both parties have agreed to terms for that contract, you give your second deposit to be held in escrow. The terms of how much money that is going to be negotiable, but generally this will range anywhere from $500 to the remaining portion of your down payment. Both of these deposits will be credited to you at closing on your down payment or cost to close. If the deposits exceed the amount you will need, the remaining balance is returned to you at closing. The last upfront out-of-pocket expense will be for your appraisal. Once we have your purchase and sale contract, we order the appraisal through an independent appraisal management company. Their job is to determine the value of the home so that you and the mortgage lender know that you are not paying more than the value of the house. They will also check for general safety items, but it will in no way be as in-depth as a home inspection in terms of checking out the systems within the house. The charge for the appraisal varies depending on the home and the type of mortgage product being used, but generally ranges from $475 to $650. This will be charged through a credit or debit card. Now that we've talked about what you will need ahead of closing, we can now get to the costs you will need at closing. The funds we will need at closing are made up of actual costs that are due to service providers and prepaid items for taxes, insurance, and interest. Closing costs are the actual costs that you incur when you buy the house. Normally, you will have some charges related to the mortgage lender for underwriting, processing, flood certificates, tax servicing setup, etc. You will also be paying an attorney to do the closing, as well as their related fees, in addition to a title search. The title search is done to make sure that the house has a clean title. If you bought a house that did not have a clean title, you may have trouble selling it at a later point. These fees will vary from lender to lender and attorney to attorney, but generally fall in around $2,500. The last part of closing costs is the title insurance. This is made up of two parts, a policy for the seller and a policy for the buyer. The total will be based on your loan amount and the sales price, so that the larger the house you buy, the more expensive this can get to be. When I work up your pre-approval and we settle on a price point for you, we can determine the estimate for title insurance for you then. Prepaid items consist of money that is due at closing but is made up mostly of an escrow impound to pay future bills for taxes and insurance. This part of any loan estimate will vary from one lender to or broker to another, but when I prepare them, I always go with what I believe will be the worst case scenario. For me, that means 3 months of insurance and 3 months of taxes, plus another 3 months of taxes to either pay the next quarter's bill or that will be reimbursed to the seller for taxes they have already paid into the time when you'll be the new owner of the house. Also, insurance is always paid a full 12 months ahead, so your first full year premium will be paid at closing. The next question is almost undoubtedly, so what happens to that 3 months you said is going into escrow if I'm paying the full year in advance? That money is being held as a cushion leading up to the next year's bill. That way, when the bill is due, there will be enough to pay if there has been any sort of increase in your insurance or taxes. Lastly, you pay interest from the day of closing until the end of the month. Your mortgage payment is then due on the first day of the month after next. For example, if you closed on February 22nd, you would pay 6 days of interest because there are 28 days in the month, and your first payment would be due on April 1. Most people try to close toward the end of the month to avoid paying more interest, but the earlier you close, the longer it will be before your first payment is due. So generally, there isn't really that much of a difference. If you're sitting there doing some math in your head, you've realized that this can all add up pretty quickly, especially if you're adding a down payment on top of this. There are 3 main ways that people can get the money to pay for this. The most obvious choice is having saved up enough personal funds. They may also decide to get a gift from family to cover the expenses. Gifts are acceptable for virtually every loan unless you're an investor, but they have to be done a certain way. Before you get money for family, make sure you have the correct documentation in place. The most common way to pay for closing costs is through the seller concession. This is where the seller gives back some of their proceeds in order to cover your closing. This has to be a predetermined amount, so once you have a loan estimate, we can determine what range you should be asking for. There are a few things that I want to cover as we wrap up that can cause problems or delays when you're doing your mortgage. These are common mistakes that some people make because they don't realize that even some of these smallest things will have an impact on the lender's decision. Here are some of the common rules that you'll want to pay attention to. Don't open any new lines of credit, no appliances, cars, personal loans, etc. without consulting with us first. This will impact your credit rating and debt-to-income ratios. Don't make any out-of-the-ordinary deposits into your bank account. Out of the ordinary would be anything other than your normal income. Every large deposit will need to be sourced to show where it came from by providing copies of the checks or pay stubs, and we can't source cash. If you happen to have money stashed at home, keep it there. This may delay or prevent closing if we cannot document the source. Do not get a gift without consulting with us first. Lenders have strict rules for how a gift is passed to applicants, and we will walk you through exactly what needs to happen to ensure the lender approves the paperwork. Do not switch banks or close or open new checking and savings accounts during the process. The lender will be looking at the history of your accounts, and if they don't match up, this can create an unnecessary and sometimes lengthy delay in the process while we explain the changes in history to the lender. Do not switch jobs in the middle of the process. Either set your new hire date to be after the closing or go over the exact detail of what is happening with us first. This will help us show the lender that there is a likelihood of continued employment and income. Lastly, don't use cash for your deposit that you put down for your offer or your purchase and sale agreement. The lender will want proof that the funds came from you, which we can't prove with cash. Other than that, just maintain a positive yet reserved attitude and get ready for this ride. Congratulations, you made it all the way to the end of Getting a Mortgage 101. I hope the information was as thorough and as informative as you need it to be for the big decisions you have ahead of you. Thank you for taking the time to go through all this information. If you have any questions at all, feel free to reach out to me at any time. If you know anyone else who could benefit from our services, I always appreciate those referrals. Also, please take a quick note to read our disclosures noting our license numbers and that as a mortgage broker, we arrange but do not make loans. Have a wonderful day, and I'm looking forward to working with you.